anyway. Okay, so today I want to talk about two other options. Right? The first is the option to expand. When people get excited about real options, this is the option that really excites. I'm going to turn this down a little bit more. It's too loud. This is the option that really am I completely gone now? Yeah. How about now? Better? Okay. So this is the option that excites these real options people. And you're going to see in a minute why it really appeals to people. Okay? Here's the option to expand. The option to expand, unlike all of the other options, is a combination of two investments. The first investment is a bad investment. You know it's going to be a bad investment. You go in with open eyes. But that first investment could give you the option to do something else, expand into a new market, expand into a new business that's worth so much that you're willing to overlook the bad investment. Okay, so it's two investments locked at the hip. So here's the payoff diagram of the option to expand. The additional investment you will have to make to expand becomes the equivalent of the strike price. What you think you will make as present value, the cash flows from the expansion, becomes equivalent of the stock price. If that happens, you will expand and make the difference. If that never happens, guess what you've lost? What is that first? How did I describe the first investment? Bad investment, negative net present value. You essentially give up that negative net present value. So here's a classic example of an option to expand. You see a large emerging market. You decide that you're going to invest in that emerging market. You know very little about this emerging market, so you expect your initial investment to lose you money. But here's how you justify it. If things work out, think how big the market is. Think of all the wonderful things I could do. You could put India or China in there, and you can see already that this is the rubric used by many developed market companies to expand into big emerging markets. They know they're going to lose money up front, but they're willing to take those losses because of the option to expand. So if you were thinking in terms of a simple project, here's an example of an option to expand. I go to Brazil twice a year. And whenever I go to Brazil, my Brazilian friends try to get me to drink this vile concoction they love in Brazil called guarana. I can never get the pronunciation right. I think it's got some drugs in it. You drink it and your head starts to get woozy. And might as well take caprinas and drink from morning to night. It's still better off than drinking guarana. But they love it. So here's the project we're going to talk about. I'm going to be the CFO of Ambev, which is the largest producer of guarana in the world. You're going to be an up-and-coming project manager at Ambev, and you're going to try to convince me to do something daring. So you come into my office. I say, let's expand into the US. I'm worried because it's a lucrative market, but it's a very expensive market to get into. So I get ready to shut the door in your face. You say, no, I've thought this through. We could introduce guarana into New York, Miami, Chicago, Los Angeles, the urban areas. The chances of it catching on are largest. And try it there. So, okay, how much will that cost us? $500 million. How much do you think we'll make in those markets? Well, it's about $400 million. So what have you already conceded? That initial investment is going to cost us, in terms of net present value, $100 million. So I get ready to shut the door again. Say, no, wait. If this initial introduction works, then we can expand into the rest of the country. So how much will that cost us? $1 billion. What do you think we'll make in the rest of the market? Well, based on what we know about the rest of the market right now, I think we'll make about $800 million. This is going from bad to worse, right? You want me to take a bad investment to get the rights to an even worse investment. But the only redeeming feature of that second investment is you haven't made the decision yet. You get to observe what happens in that initial market test before you make. Remember that decision tree I drew? 2 branches, this is very similar to that. You get a chance to learn from that initial investment, and you get a chance to adapt what you're going to do on the second investment based on what you learned in the first investment. In other words, the first investment, the $100 million net present value investment, is not an option, but the second investment can be viewed as an option. So let's lay it out and let's see if we can value it as an option. Right now, I'm sorry, I think I'm going to screw up, 750 minutes. So the second investment has a net present value of minus 250. Right now, based on what you know today, if you introduce this product into all of the US, the present value of your cash flows is 750 million, right? I said it was 800, so that was a mistake. 750 million. The cost of expanding If you decide to do it right away, it's $1 billion. So this is a in the money option or out of the money option? It's a deep out of the money option. But you know what? I know very little about the market. This is one of those great scenarios where ignorance works in your flavor, right? I know nothing about the market. I'm very uncertain about the market. In fact, based on what I can observe out there, beverage companies that are publicly traded, my uncertainty is captured in the standard deviation number of 34.2. Think of that as your uncertainty about that present value. The $750 million is your expected present value, but there's a huge amount of uncertainty there. So I put those parameters in. I put 750 million as S, 1,000 as K, 34.25% is my standard deviation. I put an artificial deadline in there because options have to have a life and say, look, Ambev has to fish or cut bait within 5 years. They have to decide whether they're going to expand to the, they can't just hang out in the urban markets looking to see if something good happens. By the end of the 5th year, they have to make a decision. So that becomes the life of the option. I plug the numbers in an option pricing formula and something miraculous happens. This is a terrible investment, right? But because I know so little about what's going to happen, the value that I get for the option is 234 million. What do I pay to get this option? I have to take the first investment, which has a net present value of 100 million. But because I took that first investment, I get the option to expand, which is worth 234 million. I sum the two up. I'm going to say, let's go for it. Now you see why people love this argument. You can do some incredibly stupid things using this argument. You can overpay on a company. I've seen people do acquisitions, pay big premiums, and you ask them, why did you do it? Because there's a real option embedded in here. That initial overpayment, the negative net present value, is overcome by the fact that you think there's an option to expand worth a lot of money. So that is at the heart of the option to expand argument. It allows you to override, in other words, it makes your traditional capital budgeting junk, right? Because you're saying, I don't care what the net present value is, I'm going to make my decision based on the option that comes out of it rather than the net present value of a project. Any questions on that? Okay. So let's think about the questions I would need to ask. So you've used the real options argument on you, right? Let's see some of the questions I need to ask. No, none of these real options can be traded. I can value the option. This is going to drive your decision process. But if you ask me, how do I monetize that option? The only way it's going to be monetized is by the actual expansion, right? So in some markets, you're going to. So the way it's going to show up is if you did this on 100 emerging markets, you will expand, if you've done the numbers right, you will expand in enough emerging markets that the portfolio of those expansions will cover the cost of your options. But there's no way you can sell that option to somebody else because it's not monetizable. It's not a tradable instrument. Right? And you can even argue that maybe using option pricing models, you're pushing the limit here because neither the option nor the underlying asset can be traded. Right? So think of this more as a sense of, when people talk about strategic considerations, what the heck are they talking about? They're talking about a real option, right? We've just replaced the word strategic consideration with a finance term, real options. So when people say we have to go into this market, we're going to lose money, but there are strategic considerations. This is exactly what they're talking about, that something might happen in the future that's going to overwhelm the cost. So this is not new. This just didn't show up 10 years ago. Companies have always done this, and they've discovered words they can use to justify doing it. This is the word of the moment, or these are the words of the moment, real options that are used to justify these actions. I think people get away with murder with real options, if you ask me. Okay? Literally. So if I were the CFO and you use real options on me, there are 3 questions I need to ask you to make sure that this actually stands up. First question I'm going to ask you is, remember you've linked these 2 investments up? First question I'm going to ask you is, do these investments have to be linked up? Why are you forcing me to do the test mark? So the onus will have to be on you. If you're using the argument, I don't need to prove that there's a link. You need to prove there's a link if you're linking them up. So is the first investment necessary for the second investment? If the answer is no, not really, I can just do the expansion, then don't make the first investment connect to the second investment. R&D and patents, the connection is obvious. Without the R&D, you cannot get the patent. Here, it's much more tenuous. It's based on your saying, if we don't do the test market, we will not learn enough. So you will then have to show me that the information you collect by being in these urban markets is helping you make a better decision on the second one. Second question I'm going to ask you, and this goes back to that exclusivity question. You're making this first investment hoping that something good emerges from it, right? So let's suppose you go in to Miami, New York, Chicago, you start trying Guarana, and everybody likes it. It just catches on. This is good for you, right? You get ready to launch it into the rest of the country. What's your nightmare scenario? The Coca-Cola beats you to it. I mean, in other words, this is not a secret, right? You're introducing in a city. Everybody can see success as it's happening. So my second question to you is going to be, what's your competitive advantage? Where's the exclusivity? Remember the word where is the exclusivity coming from? If you can convince me that you and only you can expand into the rest of the country, I will give you the entire 240 million or whatever we got as the value of the option. If at the end of your discussion I say, well, that's a competitive advantage, but it's not a complete competitive advantage, I might give you only 60% of the value. In fact, we can compute a break-even point as to where between 0 and 100% I'm going to put you to decide whether the option to expand really makes sense. So when you see these arguments used in acquisitions and investments, that is really the question you got to ask, is where is the exclusivity coming from? Because if there is no exclusivity, if there's zero exclusivity, there's zero option value. If there's complete exclusivity, you get 100% option value. In most real-world scenarios, you're going to fall somewhere in the middle, depending on what kind of competitive advantage you have. The ultimate competitive advantage is what you have with legal protection, right? Patents. Then you have licenses. Not quite as complete because often the government would retain some pricing power with the licenses. Then brand name. You have a technological edge. Little dicier because that edge could go very quickly. And when you can't think of a competitive advantage, you tell me we're the first mover. This is the worst. I mean, this is a competitive advantage because you couldn't think of any good ones, right? We were there first. What kind of competitive advantage is that? So I'll be there second. So what? Somebody else is going to be there third. But depending on the strength of the competitive advantage, I'm going to give you more or less of the value of the option. So here's the real options test. Is there an option? Yes. Loosely speaking, there is an option. That expansion investment is an option. You will expand only if the cash flows, present value, exceeds the cost. Is there exclusivity? Depends on what the barriers to entry are. You and only you can expand. So if you're with Ambev, you might decide to patent Guarana. Maybe you'll succeed. Maybe you can keep Coca-Cola and Pepsi from coming back. But that's your job. I want you to do that before we jump in with both feet and start spending money. So sometimes this will actually make you stronger as a company. If you can build in those competitive advantages, it's good for you. Does it pass the pricing test? Very, very loosely, because neither the underlying asset nor the option is traded. This is the ultimate non-monetizable real option because you can't really price it. So I can see what people are doing with the real options, with these expansion investments, but I'm very wary when I see a big number come out of it as to whether I can justify taking a bad investment based on this number. So if you see this happen, put the person making the argument to the test. Don't let them get away just using the words, real options. Ask them, where's the option, where's the exclusivity? Let's put some numbers in, let's see if it makes sense. Any questions? Yes?
So this is kind of like the issue that Roche faced recently with Genentech and the Avastin drug. They basically thought about it and hoping that it would expand into...
At least there the exclusivity comes from the fact that they had some kind of legal protection, right? With pharmaceutical companies, you can argue that at least some of the protection comes from... But once that patent life runs out, then again, the question you got to ask is, what's the competitive advantage? Is it brand name? Because at some point, once that legal protection ends, it's all brand name, right? And then it becomes a looser competitive advantage, so the option value attached will be smaller. But it happens all the time. It's not just, when you see large companies do this, small companies do this, companies going in emerging markets do this. The allure of a big market is just overwhelming to many companies. They just can't help themselves.
There would be a significant discount for potential FDA failures.
Absolutely, absolutely. In other words, but that should be in your expected cash flow already.
Okay.
So even assuming you did the expected cash flow right, you could still use an option argument with a lower cash flow. I'm just saying be wary when that option argument is used because it depends on how much exclusivity you have. Any other questions? Yes, so far.
You said the investments should be linked.
Yeah.
But then, I'm just thinking in terms of the first investment costs them 500 million, and then the second investment is at 1 billion.
Right.
So maybe they're naturally linked, but maybe you don't want to go in and spend $1 billion. you're more comfortable?
No, that shouldn't be a reason for breaking up an investment. If all you do is you're breaking up an investment because you can't afford $1.5 billion, there's no option argument there. There's some kind of capital constraint argument. The only rationale that would make sense there is you say, look, we know very little about the US market tastes. We need to make this initial investment to learn about the market. There's got to be some learning and adaptive behavior that comes out of it. So I'm not saying you can't use the other argument, but it's not an option argument. It's some other kind of capital budgeting argument you're making, which is fine. But if you use an option argument, that's what's embedded in that argument. So that's what you're looking for, exclusivity. I'll give you an example of how widely this practice runs. In the late 90s, at the peak of the dot-com bubble, I valued Amazon in the DCF model. It actually got fairly wide circulation. So in response, one of the investment banks put out a thought piece. I don't know whether to call it a thought piece or some kind of research piece, where they said, that's fine that you get a DCF value that's so low, but it's okay that the price is much higher than the DCF value. Saying, how can that be? Well, they said, well, the extra amount we're paying is for an option. Saying option to do what? Well, their argument was if you bought a dot-com stock in the late 90s, you were not buying it for the cash flows. You were buying it for the option to be part of this really huge e-commerce market that was going to emerge maybe 7, 8, 9 years later. Now, let's take that argument apart in pieces. Is there a potentially large e-commerce market? I mean, looking forward? Sure, right? So that part of the argument holds up. Can these companies become part of the market? Absolutely. Should you pay a premium for that possibility over and above your expected cash flows? I don't see why. In fact, what part of the argument breaks down? It's the exclusivity argument. Do I need to buy a dot-com stock in 98, 99 to be part of the e-commerce market? And they said, no, I could get there buying Nokia. I could get there buying GE. Why do I need to pay an 80% premium just because a company could potentially become part of a big market? CSFB, their equity research department, actually hired a real options team to justify premiums for technology companies. So that's what their job was. The equity research would get done, and the options team said 40% premium for that, 20% for that, 60% for that, based on a real options argument. So be careful with options to expand. They're very alluring, but the exclusivity is where they break down. Yes?
I see exclusivity test. Would you put the exclusivity test above the pricing test?
Absolutely. There are two different tests. The pricing test is, can I price the option? If you have exclusivity, your option is worth a lot of money. Whether I can attach a precise number to that value is where the pricing test comes in, right? So the pricing test is more a sense of, can I monetize it? But the exclusivity test basically tells me, is it worth a lot of money? And if I've established it's worth a lot of money, then the pricing test, I can live with that. I can get a rough estimate of value and know exactly what to do. This is more about guiding big decisions by companies rather than coming up with numbers for the real options. And I think people spend billions of dollars based on strategic considerations and real options. We have to put them to the test. Okay? So option to delay, option to expand. Last option, real option out there is the option to abandon. Basically, this is the option you get to walk away from your mistakes. And that's a very valuable option, right? Both in businesses and in personal life. It's nice to be able to walk away from your mistakes. It's the only real option that's a put option. Every other real option you talk about is a call option. Here's what the option to abandon looks like. If you can abandon an investment, okay, whatever you get from abandoning that investment becomes equivalent of the strike price, and you will abandon the investment only if the present value, the cash flows from continuing that investment is less than what you get by abandoning it. Okay? I know it sounds kind of abstract, so let me give you a simple example. Let's assume you're Airbus and I'm Lear. Lear is a company that makes small, corporate jets. Airbus, of course, is a company that I don't know what does what. Makes jets, but does all kinds of fighting between French and German governments in the process. But I need your input to make a business jet, or a regular passenger jet. So I come to you, begging that you become part of a joint venture that I'm planning. Okay? So it's going to be a 50% joint venture. You're going to get 50%, I'm going to get 50%. You're going to put in $500 million, and I'm going to put in $500 million. We'll each get 50%. So you do the number crunching in Airbus. You conclude that based on what you see as the expected cash flows from this investment, the present value of the cash flows to your 50% is $480 million. So right now, up front, what's your net present value from this joint venture? minus 20, right? So you come back to me and say, no, we're not interested, but I really, really want you to be my partner. So I come back to you with a counteroffer. I say, look, if you become a partner with me on this joint venture and you change your mind any time in the next 5 years, I will buy out your share of the joint venture for 400 million. Less than what you've invested, but what I've given you is a floor on your losses. You cannot lose more than 100 million because I will guarantee that I will buy your share back. I've given you the option to abandon your joint venture share any time over the next 5 years for 400 million. It doesn't make sense for you to abandon right away, right? Because right now, if you look at the present value of the cash flows, it's 480. You're getting only 400. It's an out-of-the-money put option, but it could become an in-the-money option. See this 480 million, those are based on expected cash flows. You do a simulation, and based on the variances across the present values, you come up with a variance of 0.16. So basically, this 480 million is an expected value with a lot of uncertainty. The project itself is a 30-year life, the joint venture. Let's value it as a put option. Okay? The value of the underlying asset here is the 480 million. That's what you know right now. The strike price becomes what you will get if you abandon this option, which is 400 million. The variance in the value is 0.16. So that 480 could change very quickly overnight. The life of this option is the 5 years that I give you the right to walk away. I have a question. The project itself is a 30-year life. How come I gave you the right to abandon only for the first 5 years? Why didn't I give you the option to abandon for the entire 30 years? Because what would you do if I gave you the option to abandon over the next 30 years and it's a really good project? You're going to be my partner for 29 years and 364 days. And sometime on the very last day, you're going to show up and say, you know what, I really never liked this project. So here's my advice to you. If you're going to give a joint venture partner the option to abandon, make sure that that option to abandon doesn't run the life of the project. I've seen people actually do that and pay a huge price for it. Okay? So 5 years is the option, 30 years is the project. Because this is a regular project, each year there'll be fewer years left. So there'll be next year 29. So if you think in terms of present values, the value of the project will actually drop off every year, which is like a dividend yield, right? Lesser value. So I build that in as a dividend yield. I used a 6% riskless rate. You plug it in. The value that you get for the put option here is 73.23 million. So let's step back. If you're Airbus, your share of the joint venture, the net present value is minus 20 million, right? But the option to abandon that I've just given you is worth 73 million. This doesn't guarantee you'll be my partner, but you can see how this might encourage you to say, hey, you know what? If you add in the option to abandon, I'm okay. This is actually a classic ploy in joint ventures, right? To try to get a reluctant joint venture partner, you give them some protection against the downside. Just be careful, because somebody has to pay for the 73 million, right? It's got to come out of my... Presumably, I as Lear have a large enough net present value from doing this that I can pay you 73 million and still walk away with a positive value. Okay? As I watch these Chrysler and GM ads, you see the options they're giving away? Have you seen the commercials? You buy a GM car. You lose your job, they will pick up your payments. You lose your house, they will come and buy your house for you and keep you in there. Right? I mean, they're giving away options like crazy. And what scares me is they're not paying for the options. Guess who's paying for the options? You and I as taxpayers are. This is one of the scariest option pricing ads I've ever seen. But that's all you're doing. You're basically creating options as you're going along. Somebody has to pay for them. In this case, it might be you and I as taxpayers. So here are the implications for valuation. Right? You might not be valuing individual options or joint ventures, but the option to abandon is kind of hidden behind every valuation. Here's how it shows up. Let's face it, some companies seem to have more flexible cost structures, right? So bad things happen, they're able to cut costs. Some companies are also able to get out quickly from bad situations. If you run into, I mean, Goldman, for instance, before it ran into trouble, that was their reputation. Is markets went bad, they see, it's not like they could avoid bad markets, but they seem to get out a little ahead of everybody else from bad markets. You're saying, if I'm valuing Goldman, where would I show that? You can't show it in a traditional discounted cash flow valuation, because you have expected cash flows, you have a discount rate, that's only market risk. The way you show it is by saying, hey, this company, because of its flexibility, because of its capacity to get out from downside risk, essentially has an option embedded in it. I'm not going to just go around and add 30% or 50% of the value, but it might make the difference to me between two investments that have equivalent value, the more flexible company is, in a sense, going to get a premium from me, even though it might not show up as a discounted cash flow premium because of the option to abandon. I'm always wary of companies that have entered into long, deep contracts from which they get. I mean, this is part of the reason we capitalize operating leases, right? This is part of the reason we're wary of long-term contracts. We have fixed commitments because if things go bad, those commitments still stay with us. Okay. So option to delay, option to expand, option to abandon. I'm going to actually talk about one option in the context of capital structure. I mean, the options you most commonly run into the capital structure section tend to be call options, conversion options in bonds. It's fixed income pricing. I'm not interested in those because there's another class for that. I'm actually going to talk about options in the context of what the optimal debt ratio for your company is. And let me frame the question. Remember in corporate finance we talked about optimal debt ratio. There were companies, the debt ratio of 10%, you come up with the optimal debt ratio is that point at which your cost of capital is minimized, right? When I first started doing this with companies, especially with very conservative companies, I would run into a brick wall. These are companies that would hate to borrow money. I would do the optimal debt ratio analysis. I'd show it to them. They'd agree with the numbers, and they say, well, we can't borrow that money. So what do you mean you can't borrow the money? So because we value flexibility. In fact, they'd use the word financial flexibility in this company. And how do you argue against financial flexibility? That sounds like a really good thing, right? Like apple pie and motherhood. I mean, this is not the kind of thing you want to debate against. But it would drive me crazy because that kind of stopped the discussion. So I started thinking about financial flexibility to do what? So I started turning the question back on them, saying, okay, that sounds good. You're not borrowing that extra money that you could borrow because you want to maintain financial flexibility. But flexibility to do what? And as I started eking out information from companies, this is what emerged. They wanted to preserve debt capacity just in case that investment in a lifetime, that once in a lifetime investment, that huge, great net present value investment came along, they'd be able to use the debt capacity to take advantage of it. I say, you know what? That does make some sense. You're holding back debt capacity just in case a great investment comes along. And that sounds to me like an option, right? You want to preserve the option to take that great investment. So I started framing that option in my mind as a call option. And here's how I framed it. I said this would never make sense in a world where you had unlimited access to capital. Do you see why? Because if you have unlimited access to capital, a great investment comes along, what are you going to do? You're going to raise capital, you're going to take the investment, who cares? So this, embedded in this argument is an assumption of some kind of capital constraint, that you cannot raise more than a certain amount of capital. So let's assume that the normal amount of capital you can raise as a company, and you put this constraint either internally or externally, is some amount. Let's call it L. Let's assume also that the investment you're thinking about that might or might not come has a cost of X. If X is less than L, if the investments that you have to take are less than then you don't need the excess capacity. But if the amount that you need to take those investments exceeds what you can raise, that's when you draw on the excess debt capacity to meet the constraint. So if X is greater than L, excess debt capacity comes into play. If X is less than L, you really never use it. So if I were to draw this as a payoff diagram, it's a little messy. I had to ask a follow-up question. Why do these new investments matter? Because investments by themselves are not good. It's the net present value you get from those investments that matter. The fact that these investments earn more than your cost of capital. So here's the follow-up question asked. Let's suppose you did not have debt capacity. What are you going to lose if you're not able to take that investment? What you're going to lose are the excess returns you're going to make on those new investments, right? So if you think in terms of payoff diagrams, what we should really be thinking about are not just the total cash flows from these investments, but the excess cash flows over and above the cost of capital. By keeping this debt capacity, you're able to take those investments and make that excess return. If you had not had this excess debt capacity, those investments would have had to be turned away. So it's actually a pretty messy option to value. If X is greater than L, what you lose as a present value is those excess returns you'd have made on the new investments. But if that never happens, then the excess debt capacity is just going to sit around. So here's what it looks like. They're the normal reinvestment needs you will have as a company. That you can kind of predict. Because you have excess debt capacity, when the actual reinvestment needs are greater than what you can normally cover, use excess debt capacity or financing flexibility to take the difference. If that never happens, you know what you lose? What's the cost of having a 10% debt ratio when your optimal is 30? your cost of capital is higher than it normally should be. So what you give up is actually that higher. So basically, here's a trade-off. You settle for a higher cost of capital at a lower debt ratio in exchange for having this flexibility to be able to take that once-in-a-lifetime investment that comes along. I know it sounds incredibly abstract, but I'm actually going to use an example that most of you should be familiar with. Remember we computed the optimal debt ratio? I know you don't. Act like you don't. Okay? The optimal debt ratio for Disney in corporate finance? We came up with a debt ratio, optimal debt ratio of 40%. Its actual debt ratio was 18%. At the optimal, the cost of capital was 11.64%. At the current debt ratio, it was 12.22%. So right now, Disney is at 18%. This is way back in time. It's got to be updated. It's at 18%. Its cost of capital is 12.22%. Based on the numbers, it looks like it should be at 40%, at which point its cost of capital will be 58 basis points lower. So right now, by being under levered, Disney is paying 58 basis points every year. Okay. Let's say Disney uses as a counter that the reason they're doing this is because they want to maintain financing flexibility. What we really need to be able to do is value that flexibility and see if it's worth more than 58 basis points a year. If it's worth more than 58 basis points, Disney has a good case. If it's worth less than 58 basis points, it doesn't. So I tried to value how much financing flexibility Disney was worth. And here I had to make some assumptions. Here are the variables I need to value financing flexibility as an option. First, I need to know how much your reinvestment needs are in a typical year. So this is in a normal year, how much do you reinvest? The way I'm going to do that is I'm going to take the average of net capex and change in working capital, which is how we've defined reinvestment every year for the last 5 years. Over the last 5 years, reinvestment needs at Disney had averaged about 5.3% of firm value. So I just went back and got the history. To get the variance in those reinvestment needs, I took the variance in those reinvestment numbers year to year, and because in one of those numbers, in one of those years, Disney bought Cap Cities, the reinvestment rate shot through the roof, the variance was actually a pretty high number, 0.375. So I know the average reinvestment needs, I know the uncertainty about that number. I looked at what their normal cash flows were as a company and what their normal access. So basically I looked at how much debt they typically took in a year and how much equity they used. And in a normal year, the amount that they can come up with without accessing debt capacity is about 4.8%. So that becomes my strike price. That's what you can raise without accessing debt capacity. That becomes your strike price. I'm going to do this on a 1-year basis because I want to compare to that 1-year cost of capital. I can do this for 10 years and try to compound it, but why bother? If I know what it costs me on a 1-year basis to preserve this excess debt capacity, let's value flexibility for 1 year. So those are the inputs. I'll plug them in. One final input that I need. It's not the investment itself that creates value, it's the excess return that I think I'm going to make on this investment, right? I don't know what Disney's future investments are going to look like, but at the time that I did this analysis, Disney's return on capital as an overall company was 18.69%. Its cost of capital is 12.22%. This might be asking for a lot, but if I assume that they can maintain that same excess return on the new investments, I can take whatever I got as the value of the option, 1.6092%, multiplied by the excess return, and if I assume they will earn that excess return every year forever, come up with a value for financing flexibility of 0.85%. So here's the trade-off. By being under-levered, Disney is costing themselves 58 basis points a year. By being under-levered, they can at least claim they get a financing flexibility which is worth 0.85%, which allows them to just say, we're going to stay under-levered. The value of financing flexibility exceeds the cost we're paying to maintain the flexibility. But beyond the numbers, step back and think about what makes this number large or small. First, in this case, if I assume Disney earned its cost of capital, in other words, it had 0 excess returns, what's going to happen to the value of financing flexibility? It's going to go to 0, right? So any company comes up to you, a mature company that's earning its cost of capital and talks about financing flexibility, shut them down right away. There is no financing flexibility value to a company that earns its cost of capital. So if GM talks about financing flexibility, you can laugh. If Microsoft talks about financing flexibility, do not laugh. There is an embedded, or Google talks about financing flexibility, there is an embedded value. So excess returns matter. You know what the second thing that matters is? Remember that 4.8% that I put as my limit on how much I could raise internally? Company like Disney, that's an internal constraint, right? There's no reason why they couldn't issue new shares. They just don't like to do it. If you relax that constraint, then the problem goes away. If I made K 100%, there is no value to financing flexibility. So it depends on what you see as your access to capital markets and whether you're willing to take advantage of it. So here are some generic propositions I have about financing flexibility, and we'll talk about why this matters from the context of looking at debt ratios. The value of financing flexibility should be greatest for firms with significant internal, if you think about financing flexibility, should be much greater for firms which don't have significant operating cash flows because they don't have the cash flows to cover those reinvestment needs. It should be, if you look at the value of financing flexibility, it should be much smaller for firms that have access to capital markets and much greater for firms that don't have access to capital markets. But you know what the follow-up to this is, right? I would expect emerging market companies to be far more under-levered than developed market companies. Why? Because value of financing flexibility is greater in an emerging market than in a developed market. Even within a developed market, I would argue you're going to see more firms be under-levered now than a year ago, because looking at the same markets, you're saying, maybe I can't access capital as easily as I thought I could. So your access to capital is going to make a huge difference in whether you value financing flexibility or not. Your value financing flexibility should be greater the more uncertain your reinvestment needs are. If you're the kind of company that can predict your reinvestment needs with a fair degree of certainty for the next 20 years, there is no value to financing flexibility. It should be much greater in businesses where big investments come unexpectedly and you've got to make them. In the technology business, you can see very quickly why financing flexibility matters and why you want to build in excess debt capacity. And the last thing that matters, and this is a point I made, if you don't make excess returns, don't even talk to me about financing flexibility. There is no value to financing flexibility if you basically break even in your investments. So what I want you to get out of this is not even a number, but a way of thinking about debt ratios. I'm actually modulating what I said in my corporate finance class, where I said if a firm is under-levered, push it towards its optimal. I'm saying, wait, before you do that, take a look at why they're under-levered. There are some firms that are under-levered that should remain under-levered because they have limited access to capital, they value financing flexibility, they have unpredictable reinvestment needs. I actually sympathize with Microsoft not borrowing money. I mean, it seems crazy. A company is 0% debt, it could be at 20%. How come you don't do it? I can see why they don't do it, because they're in a business where next year they could wake up and have to reinvest $10 billion just to stay in place. Unpredictable reinvestment needs, big excess returns. You can see why companies hold back on debt capacity. And I would be even more sympathetic to companies doing that now than a year ago, because if they turned to me and said, look, I can't assume I can access capital markets. Look at what happened last year at the end of the year. I can see why companies will hold back on debt capacity. Any questions on financing flexibility as an option? Yep.
Should we not attach also like a kind of insurance value to the extra cash that companies have on the balance sheet? Because we have seen many companies that were not able to.
It's the same. In fact, let's extend this argument.
By looking at the downside.
But wait. If you take we're saying that companies which value financing flexibility should have a low debt ratio, right? So your debt ratio should be 10 rather than 40, 0 instead of 10, minus 10 instead of, what does a debt ratio of minus 10% mean? If you think in net debt ratios, what am I saying? In some emerging markets, not only should you not borrow money, you should accumulate cash on top of not borrowing money. It's exactly the same rationale.
It's a different way to value it. Instead of valuing as a call option as an insurance value.
Well, it's the same thing, right? So you're saying a put option against going bankrupt?
Yeah.
You could do that as well, because remember, every call option is, if you flip it around, has to be a put option to somebody else. But it's the same basic logic that's driving the thinking, and it should give you some tolerance, at least, of emerging market companies that refuse to borrow money and accumulate large amounts of cash. If you're in a very volatile emerging market, I can understand exactly why you're doing this. This is your survival mechanism. If you did not do this, not only would you not be able to find those investments or take those investments that come along, you might not survive next year, 2 years from now. So it's essentially an option argument that's driving it. And the riskiest companies in these markets should actually accumulate the most cash and have the least debt simply to hold on. Okay. Yes?
What's the variance of the reinvestment needs? For example, is there an argument for
I'll give you an example of two companies that have a company that grows with internal investments will have less variable reinvestment needs than a company that grows through acquisitions. Right? So here's my hypothesis. Companies that grow through acquisitions should be holding back on debt capacity a lot more than companies that grow with internal projects. because the uncertainty of reinvestment means that the financing flexibility is worth more. So you tell me how you grow, whether you grow internally or through external acquisitions. I'll give you a sense of whether you should hold back at 10%, 15%, or 20% in terms of debt ratio. So there are a lot of interesting implications as to what you should expect about debt ratios across sectors, across companies, based on thinking of it as an option. So if you think about applying option pricing and valuation, there are really three places in valuation we use option pricing. Two of those places we talked about. If you have to value an oil company, I said the value of the undeveloped reserves essentially take on the characteristics of an option. If you value a biotechnology company, you're essentially buying an option on top of everything else. But there's one example of option pricing that I really haven't addressed yet, which is if you buy stock in a deeply troubled company. Let me be very specific about what I mean by deeply troubled. This is a company that's losing money, has been losing money for a while, is expected to keep losing money for an extended period, and it has a lot of debt. This is kind of a perfect storm coming together, right? You lose money, you're expected to keep losing money, and you have a lot of debt. What are you worried about? Going bankrupt, right? And here, equity in the company might take on the characteristics of a call option. Okay? Let me explain why. Think about how equity in a publicly traded company works. First, equity is a residual claim, right? You get whatever's left over after everybody else is paid off. Second, if you liquidate the company, you get whatever assets are left after the lenders have been paid, preferred stock, so there again you have a residual claim. And here's the final thing that makes equity an option. You have limited liability. Know what that means, right? You owe $1 billion. You liquidate your firm. You get only $700 million in the liquidation. You take the $700 million, you pay off the debt. You still owe $300 million, right? But because you have a limited liability, those guys can't come after your personal assets, your car, your house, etc. That's what's going to trigger the optionality here. And here's the best way to think about it. Let's assume the value of the firm on liquidation is V. Let's assume the amount you owe is D. If V is greater than D on liquidation, you get the difference as the equity investor. If V is less than D, you get nothing. That looks like a call option, right? If I replace V with S and D with K, I've got a classic call option. So here's what the payoff diagram looks like. This is equity as a liquidation option. So it's a very restrictive view of equity. Don't use this on a healthy company. This is equity as a liquidation option. You start thinking about it only if your company is deeply troubled. That's why I said only 1 out of 7 or 8 of you is going to even think about it. You're valuing GM. This is front and center in what you're thinking about the equity, right? It's not as a going concern. You're saying there is a possibility that I'm buying an option. So here's what the payoff diagram looks like. The face value of the debt becomes the equivalent of the strike price. Because if you liquidate the firm, you don't pay off market value. You've got to pay off the face value of the debt. The value of the assets of the firm becomes the equivalent of the stock price. So if the value of the assets exceeds the face value, you liquidate the firm and make the difference. If that never happens, you know what you lost, right? Whatever you paid to buy the stock in the company. It's a change in mindset when we think about equity as an option. In fact, let me set up a very simple example, and I'm going to milk it for all it's worth to draw all kinds of potential implications. So here's a firm that I want you to value equity in, and I'm going to give you the numbers on the firm. I've done all the dirty work on this valuation. I valued the assets, and I came up with $100 million as my value today. So it's a traditional discounted cash flow value of the assets of this firm today. But I'm very uncertain about the numbers, so there's a standard deviation of 40% attached to that value. So I give you the number, and I'm honest, and say, look, this is the uncertainty I have. I've done a Monte Carlo simulation, and there's a 40% standard deviation. This company has only one zero coupon bond outstanding. In a minute, I'm going to ask you why I had to make it a zero coupon bond, with 10 years left to maturity and an $80 million face value. And as a final piece of information, I tell you what the T-bond is. So I've given you the value of the firm, the variance in that value. The bond outstanding is a 10-year zero coupon bond. I've given you the face value and the maturity. And I've given you the 10-year bond rate. I'm going to argue that with that limited information, you should be able to tell me how much the equity in this company is worth. Notice I've given you no cash flows, no betas, no cost of equity, and what interest rate you should be charging in the debt. And you're saying, oh, you can give me a rating or a default spread. I don't think you need it. And here's why. Let's assume you buy equity in the firm. You bought the option, right? You have the option to liquidate. So let's characterize the inputs you would need to value this option. the value of the firm. If you liquidate it today, you'd make 100 million, so that becomes yes. The strike price, any time you liquidate, you have to pay off the face value of the bond, which in this case is 80 million. That becomes the strike price. How many years do you get to play this game? 10 years. Actually, 9 years and 364 days, but let's make it. Now do you see why I had to make it a zero coupon bond? For you to have complete power over the next 10 years, I had to make it a zero coupon bond. If it were a regular bond, what's going to be the impeding factor? Every 6 months you'd have to make interest payments, and it's not that the argument breaks down. You'll have 26-month options instead of one 10-year option. It becomes a lot messier to value. So I made it a zero coupon bond. The life of the option becomes 10 years. This 100 million could become 20, it could become 200, so I put in a variance of 0.16, and the riskless rate is 10%. So I have all the inputs I need. I plug it in, D1, D2, N of D1, N of D2. Remind me again, what does N of D2 measure? Probability that S will be greater than K. What's S here? Value of the assets, and K is the face value. There is a 63% chance that the value of my assets is going to be greater than the face value of my debt, which means there's a 37% chance of what? When the value of your assets is less than the face value of your debt, technically what's true of you? You're bankrupt, right? I've just given you the probability of bankruptcy of this firm is 37%. Some of you might be familiar with an outfit called KMV. They're a West Coast-based outfit that banks go to with loan portfolios. And what KMV gives the banks is a probability that the loan portfolio will default. You know how they come up with the number? They run it through an option pricing model. They get N of D2. They take 1 minus N of D2. There's your probability. And actually, I saw a paper a couple of years ago that estimated the probability of default for corporations using the traditional bond rating approach and N of D2. From an option pricing model, I actually found that the option pricing model did a better job of predicting bankruptcy, these really highly levered firms. So even though it seems artificial, it's actually a very powerful way of thinking about the probability of bankruptcy. So there's a 37% chance that this company could go bankrupt. I plug the numbers in, N of D1, N of D2. I get a value for the call of 75.94 million. You know what I've just valued? That's the value of your equity. Because you get the call option. The total value of the firm is 100 million, right? 100 million minus the value of the equity gives me my value of my debt. Since it's a zero coupon bond, face value is 80 million. I know what I'm paying today. I can back out the interest rate on the zero coupon bond. Riskless rate was 10%. 12.77% is my interest rate. My default spread is 2.77%. So I value the equity, value the debt. But you're able to do that only because I gave you the value of the firm as a given. If you were working from this from scratch, that's not going to be a given. You have to estimate the number, but you can see how equity starts working as a call option, especially in highly levered firms. As I said, I'm going to use this as my vehicle to actually look at some very interesting things that we've already seen in corporate finance in a different framework. Let's assume you buy equity in this firm. You pay 75. You trust my analysis. You pay 75.94 million. Tomorrow morning you wake up, you open up the Wall Street Journal, terrible news. Half your firm has disappeared. Don't ask me how this happens. You have a factory in Florida, a factory in California. You take your pick. One of those factories has slipped into the ocean and wasn't insured. So your 100 million is now 50 million, right? This is not good news for you as an equity investor, obviously, because you bought the stock yesterday when the firm was worth 100 million. But I have a very pragmatic question for you. The value of your equity used to be 75.94 million, right? You've now lost half the firm, $50 million. My question is, what is the value of your equity going to be today after this news item comes out? And I'll give you three choices. It'll drop to exactly 25.94, which is the 75.94 minus the 50 million. In other words, you take the entire firm value loss and you bear it on your shoulder. It could be worth nothing. If you listen to your accountant, they're going to look at the book value and say, oh my God, the whole company's worth nothing, the equity's worth nothing. Or it could be worth more than 25.94. In other words, you don't bear the entire $50 million loss, which does create a problem, right? Somebody's got to bear the loss. If you don't bear the entire loss, who else is there left in this firm to bear the loss? The bondholders, right? They don't want it. They're going to be dragged in, kicking and screaming. Say, please, please, keep the loss to yourself. They say, no, come on in. You're my partner now. In fact, that's it. All I did was I took exactly the same inputs I used before, just replaced the S. 100 became 50, kept everything else fixed. Let's see what happens to the value of the equity. Reminder again, The value of the equity used to be 75.94 million. The probability of bankruptcy used to be what? 37%. What do you think is going to happen to that probability after this happens? It's going to go up. Let's see how much it went up. Right? So I plugged in the numbers. Look at NFD2. That 36% chance of bankruptcy has now become a 58%. Saying I expected that. The value of your equity, which was 75.94, is now 30.44. You lost $45.5 million. The 20.44 becomes 19.56. Now you've dragged in the bondholders, and they're losing some of the money because the probability of bankruptcy has gone up. Once I got started on this, I couldn't stop. You know what I mean? I dropped it at 40. I wanted to see when equity becomes worthless. It's a question that sometimes you look at a stock and say, how the heck is that stock even trading? But stock still hangs in there. So I wanted to see when equity becomes worthless, and you know what? I couldn't. Equity is this incredibly stubborn instrument. I dropped the value of the firm to $3 million. It still owed $80 million, and equity kind of hung in there. So let me ask you a question. What's allowing equity to stay afloat in the face of all these incredible values? What is it about this example that's keeping equity afloat? What's working in your favor? What's the only thing you have working in your favor? You have 10 years where you can sit and hope that something good happens. You know what? You've just bought a deep, deep out-of-the-money option. And think of why you buy deep out-of-the-money options. Most of the time, what happens to deep out-of-the-money options? They end up in the trash can. You're hoping for that, no? It's the life left in the option that's keeping it alive. The closer you get to the maturity of the bond, the closer the equity value would go to zero. I used to think that the definition of bankruptcy was that the value of your assets was less than the value of your liabilities. That's what I was taught in finance. My daughter taught me different when she was 3 years old. She's actually a financial genius. Not really. So she was 3 years old, and it was a summer. I used to play Monopoly with my 2 older sons, and she would insist on joining in. She's very persuasive, so finally we let her in. So Kendra, you're in. And she was like a one-person Enron. She would take money from the bank. She would take 200 for not passing go. Every time she went around a corner, she collected 200. And nobody was watching. She started stacking up hotels on property she didn't own, insisting you paid her no matter what. She was like a Donald Trump and Enron together, right? So finally I said, Kendra, you're banished. Tiny little person, but terrible temper. The witchy woman song kind of fit her, you know. And so with this cloud over her head, she starts walking around and says, you're bankrupt, you're bankrupt, you're bankrupt. I was very impressed, 3-year-old using the word bankrupt. So I said, Kendra, what does bankrupt mean? Expecting an answer like the value of your assets is less than the value of your liabilities. She says, bankrupt means you don't get to play the game anymore. And you know what? It's a perfect definition of bank. It's a definition that Carl Icahn understands, that Ron Perlman understands, that as long as you get to play the game, you are not bankrupt. That's what's keeping the option afloat here, is that you're getting to play the game, and because you get to play the game, you still have some life left in you. So think about that. When you think about buying stock in deeply troubled companies, you're buying them for the same reasons you buy deep out of the money options. In fact, I'm going to build on them. Right? This gets equity value kind of hung in there. As you can see, even when I dropped to 10, 3, equity value stayed in there because it's the life of the option. In fact, we can make some statements about equity in deeply troubled firms based on treating it as an option. If you're looking for, let's say you're a vulture investor. You know what vulture investors do, right? They buy equity in these deeply troubled firms. Let's say you're a vulture investor. Do you want to buy stock in deeply troubled risky firms or deeply troubled stable firms? Think of why. What do I say? When I say deeply troubled stable firm, what am I saying? You've lost 200 million. I'm so certain you will keep losing 200 million that I'm willing to bet on it. Why would you want to buy stock in this company? So in other words, risk is no longer your enemy, it's your ally, right? Do you want to buy equity in deeply distressed firms with really long-term debt or really short-term debt? You want long-term debt, the life of the option, right? So keep that in mind when you think about equity in deeply. Not all of them are made equal. You're buying an option, you've got to think of it like an option. Don't think of it like a traditional stock. Don't think of dividends, don't think of cash flows. Think of it the same way you think of an option. Here's the second example I'm going to take and use this to kind of illustrate a point. So let's take this firm, value of equity is 70. So let's revert back to the original example. Value of equity was 75.94, value of debt is 24 million, and the value of the firm is 100 million, right? So that's the original. Let's assume you now have the opportunity as a company to take a project with a net present value of minus 2 million. Already the danger signal, negative net present value, capital budget, no, don't take it. But but not only is net present value negative, it's a really risky project. This is getting worse, right? Negative net present value and risk. But as the equity investor in this company, do you see why you might still want to take this project? If you take this project, what's going to happen to the value of the firm? There's 100 million before. Net present values are additive, so it's going to become 98 million. Saying there, I told you it was a bad thing to do. How much do you still owe? 80 million, right? But this was a really risky project. By taking this project, let's assume your variance in firm value went from 0.16 to 0.25. You made the firm less valuable, but the firm's a lot riskier, right? You own an option on the firm. I put in these numbers in. Remember that 75.94 million you had as a value of equity before you took this really bad, really risky project? Here's some corporate finance miracle at work. Your value of equity goes to 77. You did the worst thing possible in a corporate finance book, and I'm rewarding you by giving you an extra 2 million in value. You see who the big loser is, right? The big loser here, of course, is a bondholder. You know what the lesson embedded here is? You're a bank. You're lending on an LBO. You lend like you do on a traditional bank loan. You are asking for trouble. Because once those equity investors in the LBO have your money, they're going to do a risk-sharing game. And the risk-sharing game is they will take a lot of risk. They'll give you the bad side of the risk. They'll keep the good side of the risk and walk away with it. Which means if you're lending on a highly leveraged deal, what are some of the things you need to do as a bank? First, you need to be part of that big decision-making process. You need somebody on the management keeping an eye on the management. You can write in covenants, but that's not going to do it. You have to actually be there when they make the decisions. You can't let the equity investors run this firm, because if they run the firm, they're going to do it for their best interests. You got to come in there and stop the risk-taking. If they don't stop the risk, this is like being in a casino. You've lost all your money. You lost your house. You've lost your car. So basically, you're bereft. There's nothing there. The casino comes and lends you $500,000. Don't even ask me why they're doing this. They just really like you. They give you $500,000 to bet. Let me ask you a question. Are you going to be really careful about where you bet with this $500,000? Or are you going to take the $500,000, put it in number 23? I mean, after all, you're already bankrupt. What difference does it make whether you're bankrupt and a half? I mean, it's like drowning in 9 feet versus 11 feet of water. What difference? You're dead either way, right? If you let equity investors who are so far in the hole make decisions, they don't care about downside anymore. There's not much downside left. They're looking for the maximum upside, which means you take the most risk you can because you hope to use it to kind of get out of the hole. This is what we talked about in the context of capital structure. We called it agency cost, right? But this is what agency cost is. You're a lender, I'm an equity investor. You can see agency cost at play in the option pricing model. That's the second example. Let's take a third one. One by one, we're violating every corporate finance principle. Let's continue, right? Let's assume you are the manager of this firm and you decide to do an acquisition. You decide to acquire another firm with a fair market value of 150 million, and you pay the fair market value. So you did the right thing, right? You paid fair market value. Assuming markets are efficient, that your values before were correct, what do you think will happen to the value of your equity when you do this acquisition? Now, after all, what does traditional corporate finance say? If you pay fair market value, your net present value is 0. Your value of equity should be unaffected by what you do, right? But let me flesh out the numbers here to see why you might care as an equity investor. You're the first firm. There's you. Right? There's the second firm that you're buying. Let's assume these two firms are in slightly different businesses. So the correlation between the firms is only 0.4. In fact, that's going to be true for almost any two firms. Even in the same sector, the correlation is not going to be 1. So what? After the merger, the variance in firm value will be the variance of the combined firm, right? Remember the two asset portfolio equation? I know you, do you remember? Starts every portfolio theoretical sigma is a variance of A times the weight squared, and then the last term, which is the covariance term. So you now have a combined firm. You can work through the math, but you can already see what's going to happen. Because the firms are not perfectly correlated, the variance of the combined firm is going to be lower than the variance of either of the two firms. So let's think about the trade-off here. You paid fair value for this acquisition. The variance of the combined firm, though, is far lower than the variance of the two firms. So if we think of equity as a call option on the firm, what's going to happen to the combined value of equity in this firm? Less variance. The equity is going to be worth less. Guess who's going to gain? The bondholders are going to gain. Why? What is it about what's happening here that's making bondholders happy? You lend money to these two firms based on the original risk, right? You set interest rates based on them. Now they become a combined safer firm. You still stay at those interest rates, which effectively is what's causing the transfer of wealth. Of course, you as the equity investors can try to claim that back, right? What are the two ways you can claw back some of this lost value? One is you can go to the banks and say, hey, those old interest rates, no more. We're a safer firm, we need lower rates. Or you can really undercut them by funding this acquisition with a lot more debt, right? If you're a conglomerate, which is basically what we're talking about, and you're building yourself up by acquiring firms, my advice to you is increase your debt ratio as you go along, because if you don't, you're going to transfer wealth from the equity investors to the lenders, because the combined firm will get less risky as you go along. You have to counter that. But you have to do it explicitly. It's not going to get counted on its own. And if you don't do anything, the bondholders are going to walk away with the premium. And you can see that reflected here. The value of the combined equity drops by $3 million because the combined firm is less risky than the individual firms that went into the piece. So here's my hypothesis. Conglomerates that don't use debt, you should see equity values slide over time because of this transfer. The conglomerates that actually know what they're doing should increase their debt ratios as they become more diversified. Louis, you had a question?
Yeah, normally when this happens, debt remains under each one of the operating companies.
But it doesn't matter, right? Even if it stays the operating companies, as long as the claim is against the parent companies. If it stays as just debt against those assets, you don't get a claim against a combined company.
Exactly.
Then, but if you take Procter & Gamble and Gillette, most mergers, you don't have two individual operations yet, right? Time Warner AOL, it's one company. So in fact,
The debts don't cross to the other.
sure they do. If you're an AOL lender, you have claims against, once you become a consolidated company, your claim against an individual asset might not, but your secondary claim is against the primary company. So unless you, so that might be something you try to explicitly do, but if you don't explicitly do it, the claim is going to shift against the combined company. So you look at so if you're a subsidiary of GE, your claim is against GE, the company. You lend to GE Aircraft, GE, the company, backs it. Okay. So it's doable if you wanted to, but you have to actually go out and do it. So let's think about applying this to a real company. I mean, this is a very hypothetical example. I said, I gave you the value of the firm, I gave you the standard deviation, made it one nice zero coupon bond. You try this on a real trouble company. Doesn't even have to be GM. It could be some small trouble company. Here are some of the issues you're going to run into. First, I've assumed only two claim holders in the firm, debt and equity. You look at trouble companies, everybody and his brother is a claim holder. You've got senior debt, subordinated debt, junior. They're all fighting their own fights, fighting within each other, inside stockholders, outside stockholders. It happened in Marvel. When Ron Perlman was the inside stockholder, he was trying to rip off the outside. Basically, everybody was trying to rip off everybody else. It's like a five-person game. It's a much more messy game. Second, I assumed only one debt issue, and it was a nice zero coupon bond. You take a troubled company. They borrowed money from everybody under the sun. They've got 15,000 different bond issues, short-term, long-term, different currencies. So it's not going to be one nice zero coupon bond. And finally, I gave you the value of the firm, and I gave you the variance. In the real world, those numbers have to be estimated. So let me at least set up the estimation process. So I'm trying to take a real company and frame it in the same terms that I had for the hypothetical company. First thing I need is a value for the firm. I'll give you a couple of ways you can do it, and you make your pick as to which you'd like. One is I can take the market value of equity and the market value of debt, add them up, and say that's the value of my firm. The reason that's cheating is I then take that value and I break it up and say this is my new value of equity and my new value of debt. If I think the market is right at the first step, It's kind of disingenuous to say, I don't like what the market did in the second step. So here's a better way to come up with the value of the firm. And this is actually directed at those of you who have troubled companies with a lot of debt. You did a DCF valuation of your operating assets, right? If you take that DCF valuation and you strip out the growth component, you know why you want to strip out the growth component. This is the value you get from liquidation. So you want to kind of value this firm if you sold it today. What you get as a DCF value will be the value of the firm. That's the $100 million that you're going to put into the model. If you're too lazy to do that, here's the third way you can get a value for the firm. You've got the operating income now. Apply a multiple based on what stable companies in the sector trade at. You've essentially got your starting point. That's your value. So basically what you're trying to estimate with all three is what will I get if I sell the assets of the firm today. For the variance in firm value, here's the long way you can do it. If your stock is traded and your bonds are traded, sometimes happens, troubled companies, both the debt and the equity are traded, you can use the variances in stock prices and bond prices to back into a variance in the value of the firm. Okay? Sounds fancy, but I'm using that two-asset portfolio that we start every portfolio theory with. So that'll become the variance of equity, the variance of debt, and the covariance between debt and equity. I'll show you what I did for the example that we're going to do. If you have both traded stocks and traded bonds, you could try to do that. It's a lot of work, though, and I would not recommend it. Because especially with troubled firms, the stock and the bonds do really weird stuff. So here's my fallback position, and it's a position that actually is very easy to do. Remember how we got bottom-up betas? I gave you a chemical company and said use the beta of a chemical company. I give you a troubled chemical company. Why not use the variance of all chemical companies? If I could give you the variance in firm value by sector, you could use that bottom-up variance here. And if you go to my website, under updated data, you'll see variances by firm value for every sector. So take your sector, look up that variance, plug it in, move on. It's not worth the effort of trying to estimate this number for your company. So that's going to be the variance. Now let's deal with the troublesome part. I'd really like to take all their messy debt and make it into one nice zero coupon bond, right? That'll make my life easy. So here's how I'm going to cheat. I'm going to take all the debt that this company owes and consolidate it, face value. I'm actually even going to add the coupons on. So this is the total amount I owe. I'm going to treat that as the face value of my zero coupon bond. I have 20 different bond issues. Each has a different maturity and a different duration. I'm going to take a weighted average of those durations, weighted by how much money I own each type of debt. And that weighted average I'm going to treat as the duration of my zero coupon bond. In other words, I'm going to replace this complex debt with an equivalent. It's cheating. An option purist would go crazy if you saw you doing this. But the alternative is too messy for me to even contemplate and actually attaching a number. So that's basically how I'm going to input numbers. So I'm going to apply this on a company. The company I'm going to pick is Eurotunnel. This, of course, is the company where it's a hole in the ground where cash goes in but never seems to come out. Okay? The hole in the ground happens to connect England and France. Okay? But it was built with a lot of fanfare about how much money it would make, and it's never made money. So this was way back in time, 1997. It had operating losses of 56 million pounds. And to show you how long it's had losses, its book value of equity had become negative. It had lost money long enough. So it meets the first condition. It's losing a lot of money. Let's look at the second condition. It owed almost $8.9 billion in debt. A lot of it really long-term debt. In fact, cumulatively, the $8.9 billion in debt had a duration. So I actually compute the duration. If you're too lazy to do duration, just take a weighted maturity. It's not going to be that far off. So in this case, so here's what I'm going to do. I'm going to act like a 1-0 coupon bond with that face value and that maturity. I need a value for the firm, right? So I turn to my DCF toolkit. I projected out the cash flow. So I did everything you're supposed to do with a troubled firm. Kind of dug it out of the hole. And here's the bad news. Even assuming they get back to health and taking the present value of the cash flows, I assume margins would improve, debt ratio would become a stable company's debt ratio. The value that I get is 2.3 billion. You know why that's bad news? How much they owe? 8.9 billion. As a healthy company, the value that I get is, this is a deep, deep out of the money option, right? You say, why would anybody buy stock in this company? Hey, let's put the numbers in. Last thing I need is a variance, right? Here, I actually look for a bottom-up variance, but there aren't too many holes in the ground or tunnels that are publicly traded, so I kind of gave up on that. One of the few cases where I actually gave up on a bottom-up number. But I was able to find Eurotunnel stock and Eurotunnel bonds, which were both traded in the London exchanges, looked up their standard deviations. Okay, 41% for stock, 17% for the bond. Looked up the weights for equity and debt, 15% equity, 85% debt. Looked up the correlation between the two because I had the Excel spreadsheet with returns on the bond, return on the stock. I just did the correlation, put the correlation in, which is 0.5. Came up with a variance in your return of firm value. The 2.3 billion I have as firm value could change based on that variance. I used a 15-year bond with a was at 6%. It's roughly, duration was about 11 years, which is the duration of my option. I use that as my risk-free rate. That's it. I plugged it in. S is 2.3 billion. K is 8.9 billion. Duration of my bond is that 10.93 years. Face value of my debt is basically captured there. Riskless rate of 6%. Tell me again, what's the chance that Eurotunnel will go bankrupt? 92.5%. No surprise, right? When your value of the firm is 2.3 billion, you own it. But here's the amazing thing. Look at that value of the call. Remember we talked about equity being a deeply stubborn instrument? Value of equity is 122 million. This is a case where if you tried any other valuation approach in the Eurotunnel, there is no way you will ever justify the value. Because it won't work on a DCF basis. The cash flows are all negative. It won't work on a relative valuation basis because what are you going to do relative to? This is a pure option play. So if you buy Eurotunnel stock, don't depress yourself by looking up earnings announcements. They're only going to contain bad news. You know what you should be watching for? Every time a bond comes due, look at what happens. And you're going to be in good luck here because if you look at who Eurotunnel owes money to a French bank and the bank has a loan come due, guess what the French government does? It puts pressure on the bank to extend the loan. This is like having an option where a fairy godmother shows up. Kind of it keeps extending the, 11-year, make it a 15-year option. The fairy godmother here is the German and the French government. So get down on your knees and keep hoping they do what they're doing because that's what keeps the option going here, is that it's a light that keeps extending. Yes, Kevin?
Does the open interest give you any sort of inkling into this result?
Yeah, you could probably see it because in a sense you should expect to see the open interest kind of surge and fall depending upon what's happening with the renegotiation of the debt because you always worry as an equity investor that in the process of renegotiation the equity might get restructured, right? Because we're assuming the equity is fixed and the debt is fixed, but in games like this one they could go into a room to negotiate. When they come out, your equity is gone because they've decided to take the debt and make it into equity. So you've got to worry about those changes that can happen. But buy this stock and value it for the reasons you want to do it. It's not a cash flow asset. It is an option. It's a deep out of the money option. It's got to be valued as such. Yes?
Given that in real life it's not a zero coupon and you need to pay
No.
interest.
This is actually what I did was I took all.
No, I'll get there. So instead of using the average duration, wouldn't it be better to use the estimated amount of lifespan the equity shareholder might have until he gets into Chapter 11 and the bondholders get into command?
That's like a shorter, the most conservative life. You could do that. If you have 3 big bonds outstanding, you can value to the first bond, saying if I don't make it through that first bond, I'm not going to make it through. So rather than bring all 3. But here's the thing, if the value of the firm is greater than that first bond, they're going to find a way to survive that first bond and move on. So it's only if you have 3 really big bondholders and 1 small company that this is going to work. Eurotunnel has 20 banks. Any one bank comes up, there's enough of an incentive for Eurotunnel to keep the game going. So they play the banks off against each other because there's an incentive for the banks to keep going. Okay? So that's pretty much the last step here. The one thing I want to show you is, sorry. Okay. So the closing thought about real options is be cautious. When you see real options, I'm not debating the fact that they're options. My point is if there's no exclusivity, don't attach significant economic value to them. And even when there's exclusivity, be cautious about using pricing models because many of the conditions don't get met. Okay? So when we start off, I'm going to actually send you, I know you have enough on your plate, I'm going to send you like a 10-minute pre-class quiz. I always never do this. It's going to be for our next discussion on acquisitions. It's actually 7 questions. It's very simple questions. I want to see how embedded valuation principles are within each of you. Let's see if you get all 7 right. Okay? I actually tried the same quiz on a bunch of CFOs of acquiring companies in New York a couple of years ago. I don't even want to tell you how many they failed. It was kind of scary. Hey, but we'll start off on Monday with that discussion. Yeah.
I understand how the way you value the options, right? But I was wondering, doing a real bankruptcy, like
Once you declare bankruptcy, there's no option.
okay, so it's okay. So
Yes,
this is
it's
before,
pre-bankruptcy.
yeah, because I was wondering, of course, stakeholder gonna get paid first, right?
Once you get back, once you're into bankruptcy, the option is gone. This is the option before you liquidate. The option.
Okay.
So this is troubled companies before they actually enter Chapter 11 and enter the bankruptcy process.
Okay.
Which is where GM and Chrysler, they're not quite bank, but you worry about it coming, right?
Okay.
So that's why the option happens.
Right. Cool.
Funny because I had a question similarly because I was looking over that APV when they're talking about the expected bankruptcy cost, and I guess that's kind of like a way of sort of getting at the value.
But that will cut the other direction. Bankruptcy is always a bad thing. They reduce the value of their equity. This is the flip side of bankruptcy, where equity investors are actually using bankruptcy as a leverage to kind of increase their value. Right?
Okay.
Everything we do in traditional valuation, the value of value of equity gets lower when you have bankruptcy.
Right.
This is one potential benefit you get as an equity investor. Is as you get closer to bankruptcy, your equity starts to behave more and more like an option.
Right. Right.
So
Okay.
it effectively means it's not the value of the firm is changing, but you're redistributing what from the bondholders, the equity investors, which will get changed.
Exactly. So for example, one way of trading is I'm just thinking is that if you had some information, or at least if you thought that there was a high likelihood that, say, the French government was actually going to extend it, could you get into that position maybe before that information and eventually kind of, because that would
That's
naturally
exactly what you're looking for.
Okay.
And if you assume that they always happen, just get into it before the next big bank loan comes due. On the expectations, they've done it the last 17 times. Why is it going to be any different the next time?
Exactly. Yeah.
Hi.
Hi. On that first put option on the projects that you're talking about, how's that different than just being a sunk cost on a project?
No, this is not sunk. The 400 million that they're going to pay is actually an incremental cash cost. None of those items are sunk, right? You haven't entered into the joint venture yet.
Okay.
So the 480 million is all in the future.
Right, but just on to compare it to a different project, if you're going to put in, 480 million or 500 million, and
The 500 million never entered into the picture, right? Once you invested that, that's gone. So that was
Okay.
not in the option at all.
okay,
It's you entered you paid the 500 million, you're now in a
but
joint
you'll
venture.
get the 400 back.
The 400 you can get back at any time you get out, so it's incremental.
Okay.
It's not sunk. The 480 million is the present value of future cash flows. It's all incremental. It's based on what you see coming in the future.
Okay.
The 500 million was not even part of our option. That was what you paid up front. That nobody cares about. That's gone.
Okay.
This is all about looking forward, looking at when you want to abandon. Basically, it says you will abandon only if you believe that the present value of your future cash flows is less than what you can make by abandoning. You're not making your 500 million back. You're making what we explicitly state, which is the abandonment value back. So that's got to be contractually specified that you make 400 million back. Somebody's got to pay you.
Okay. Okay. Thanks.
Yeah.
I think it's funny that Novell has a trademark and Client has a trademark.
Who does Clyde belong to?
I have no idea. It's awkward. So I'm trying to sneak back 1.5 points. So this one, I did this, and I saw that both of them, in both cases, A was the lowest. So I think you said, I think in your notes it says if you, I couldn't figure out. I'm really bad at these terms. Because sometimes in your notes, sometimes you don't call it minority holdings, sometimes you call it majority.
Now, what did you do? You just took debt plus equity minus cash, right?
No, that was that was this column, and then I did it a second time by adding both.
Adding both to,
Meaning
adding both.
both.
Okay, then you should get half.
So
point.
that should be only a half point
Yeah.
off, I think.
Yeah.
And then this one, I think it's only a minus because I started with this value.
Oh, that this is the star.
So I think I just did.
Okay, that's right.